Hi, my name is Weiren, Senior Portfolio Manager at iFAST. In this episode, I'll be talking about China. For 3 years, China has implemented zero COVID, which has led to the effective control of the pandemic with citywide lockdowns, mass testing campaigns, and extensive contact tracing. However, these efforts have come at a great cost to the economy and has fueled protests in several major cities. As the government comes under increasing pressure from surging cases and public anger, policymakers have signaled a retreat from zero COVID in recent times. On the 11th of November, China announced 20 measures to streamline its COVID-19 controls. Major cities from Beijing to Shanghai and Shenzhen have also moved to relax their COVID-19 restrictions. In addition, the government also announced 16 measures to support property developers. On 7th December, China announced another 10 measures that further eased COVID-19 restrictions. Markets have clearly welcomed these changes, with the MSCI China Index up by close to 30% since November, while the Hang Seng Tech Index has also jumped by 36% over the same period. Is this the time to jump back into Chinese equities? We don't think so. We believe investors are getting ahead of themselves, and there are reasons to believe that this rally will not be sustainable. Despite easing its zero COVID policy, a large proportion of China's economy remains under lockdown as a result of surging COVID-19 cases that have hit record highs in November. According to independent research conducted by draconian, around 1/3 of China's GDP is still under some form of lockdown. That's equivalent to the size of India's economy and not too far from the previous peak in mid-April. Furthermore, COVID-19 cases have been rising so rapidly that there are now close to 2 million close contacts under medical observation as of 7th December, far more than during previous outbreaks. All these have stunted economic activity and consumer confidence. Sales of movie tickets, which is a gauge of people's willingness to go out, plunged 70% year-on-year to an 11-year low in November as more than 60% of the country's cinemas remained closed. Subway traffic in China's 4 largest cities by GDP, which is Shanghai, Beijing, Shenzhen, and Guangzhou, was down by 32% year-on-year in November. A measure of road freight in the week to 4th December fell for the 3rd consecutive week and was close to 40% below its level the year before. Meanwhile, domestic flight activity has also dropped sharply in the past 2 months. On paper, China has eased its zero COVID policy. In reality, a large proportion of the economy remains subjected to lockdowns. The positive impact from China's reopening will also not be felt straight away, as China has not undertaken the preparations that would be needed for a safe reopening. China's elderly population remains under-vaccinated, with just 40% of those over 80 years old having had booster shots. To put this into perspective, 90% of those over 80 in Singapore have received their booster shots. Importantly, China's healthcare system is currently not equipped to handle an inevitable surge in hospitalizations. At this point, China has fewer than 4 ICU beds per 100,000 people. This is much lower than the 30 ICU beds per 100,000 in the US. A rapid reopening at the start of winter could swamp China's healthcare system and bring about the waves of deaths that the party has so far boasted of avoiding. Even if China is able to ramp up its vaccination drive and healthcare resources within a short period of time, a deep-rooted fear of COVID-19 presents yet another roadblock. For the past 3 years, the Chinese media has portrayed COVID-19 to be so dangerous that China needs to be locked down to fight the virus. As such, fear of the virus is ingrained in the population. In recent weeks, as rumors spread that Shijiazhuang was about to lift most of its restrictions, the city was gripped by fear and panic, as parents voluntarily kept their children home from school consumers stocked up on necessities, and there were few people on the subway. In order to convince people to live with COVID-19, China will need a whole new public communications campaign. All these will take time. Even if China were to end its zero-COVID policy immediately, the positive impact would not be felt straight away. Besides shifting away from zero-COVID, China has also announced sweeping measures over the month to support its property sector, signaling that its crackdown on the sector may finally be over. Success is far from guaranteed. This is not the government's first attempt at reviving the property sector. In fact, authorities have implemented a series of support measures over the course of 2022. Despite all these measures, the property market continued to deteriorate. Furthermore, China's property market is suffering from a confidence crisis. Home buyers are not even convinced that developers have the ability to deliver the properties that have been pre-sold. Across China, just 60% of homes that were pre-sold between 2013 and 2020 have been delivered. As such, prospective home buyers have been reluctant to part with their hard-earned savings to purchase a property they may never ever get to see. To restore confidence, developers need to finish the uncompleted projects, but this will take time, especially if the developers need to be restructured first. That is not all. Even if prospective home buyers are confident that a property they purchase will indeed be completed, they may not feel confident about their own financial situation, given the uncertain economic outlook and falling home prices. To make matters worse, more home buyers could delay their purchases as they wait for property prices to fall even further, creating a vicious cycle where falling demand for property causes home prices to fall even further. As such, we do not expect home sales and home prices to recover in the near term. This will have negative implications for China's economy. As housing accounts for almost 60% of household assets in China, falling property prices would have a negative impact on household wealth and consumption. To conclude, even though a bullish consensus for the Chinese equity market is emerging on Wall Street, we remain unconvinced. There are also longer-term issues to worry about, including China's shift to a top-down, state-controlled economy, as well as rising geopolitical tensions with the West. As such, we reiterate our view that China is no longer an attractive market to invest in and recommend investors to underweight China in their portfolios. For investors who have a high concentration of Chinese equities in their portfolios, it would be prudent to reduce their China exposure gradually. Any short-term rebounds should be seen as an opportunity to reduce exposure. Given the strong rebound in Chinese equities over the past month, this could be the right time to reduce. Where should investors redeploy their capital? At the asset class level, we now have a preference for fixed income over equities, as we are starting to see attractive value emerging within this asset class. Within fixed income, our preference is for short duration bonds, as short-term bond yields have moved significantly higher as compared to long-term yields. An unconstrained bond strategy is also viable as it allows for better management of interest rate risk in this tough environment. Within equities, we now prefer the US and Japan. Furthermore, given our expectations that inflation is likely going to be higher for longer, value stocks and commodity-linked equities will be amongst the winners. We also favor Latin America and ASEAN equities. ASEAN in particular will likely be a major beneficiary of the shift away from China. With that, I've come to the end of my sharing on China. Thank you for listening, and I'll see you again in my next update.